Okay, so we're going to work some problems with these that relate to corporations. First one is exercise 12.1. These are in your textbook. This is a textbook version, not the algorithmics. And so we'll start out with this one about Marie and Ramesh. Marie and Ramesh form Roundtree Corporation with the transfer of the following. Marie forms personal services for the corporation at a fair market value of $80,000 in exchange for 400,000 shares of stock. Ramesh contributes an installment note receivable, basis of 25,000, fair market value 30, plus land with basis of 50 and fair market value 170, plus inventory with a basis of 100 and a fair market value of 120 in exchange for 1,600 shares. They want you to determine Marie and Ramesh's current income, gain, and loss, and calculate the basis that each take into the Roundtree stock, that each takes in the Roundtree stock. So how much basis will they have? And there's new stock that they're changing their assets into. Okay, so the first thing you have to look at is Marie is giving services instead of assets. So it might not qualify as a 351 exchange because of that. So we have to make sure that even with that fact that she's using the services to get her shares, there might not be 80% control of the individuals who are giving assets. So let's look at it again. We see that she's getting 400 shares of stock and Ramesh is getting 1,600. So that's a total of 2,000 shares that are being issued, and 2,000 times 80% means 1,600 shares. So from that, we can see that it's going to be okay. It can be a 351 transfer, but it just won't be that for Marie because she's not giving assets. So for Ramesh, though, he can still do his 351 transfer. So because we know what's going to happen to Ramesh, let's just go ahead and say Ramesh has income of 0, no taxable income, and he will have basis in his shares of stock to the exact same amount as his basis in the assets he's transferring. So he's transferring 3 assets, with one of them being the note receivable at 25,000 and the land at 50, so that's 75, and then the inventory at 100, so that's 175. He's got basis of 175 in these assets. It's a 351 transfer, so his basis in his stock that he owns after this transfer is done, the Roundtree stock, is 175,000. So that's straight up 351 transfer, no taxability. It's beautiful. But that's not what's going to happen for Marie because she didn't transfer any assets. Instead, she gave her services, and the corporation needed her services, evidently, because they said, if you will provide these services, we will give you this 400 shares of stock. So all this means is, fine, she's going to get her shares of stock, but she's going to have to pay tax on that $80,000 value for the 400 shares. So she has income of 80,000, and the fact that she paid tax on the services means she also takes her shares at $80,000. So she basically, even though she didn't pay a dime for the shares, she got a step up in basis, to sort of like a step up, because she paid tax on her services she provided in order to get them. So this is what they want. They want you to say Marie has to pay tax on her shares that she's getting, or her services that got her the shares, and that also is her basis in those shares after the transfer is made. And then because of 351 not being a taxable event for Ramesh, he has no income and he has a carryover basis of 175,000. So that's all they ask you. They didn't talk to you about the basis that Roundtree would have in these assets, but they would actually be the same as these. So that problem is not too much. It was just asking you to differentiate what would you do if services was part of the amount contributed. So now let's look at 2. This 12.2 is about whether or not it's going to qualify as a 351 transfer. Grady exchanges property with a basis of 12,000 and fair market value of 18,000 for 60% of the stock in Edie Corporation. Pedro acquired the other 40% of the stock 5 years ago. So whenever Grady contributed this money, or these assets, into the corporation, he's not going to own 80% of the shares. And neither did Pedro because he didn't have 80%. Well, that's not the fact. At the current moment, 80% of the shares are not being transferred by Grady. And so they want you to calculate Grady's current income, gain, or loss, and the basis he takes in the shares. Because the transaction is not or does not meet the control of the corporation requirement, Grady has a gain of the difference between the fair market value and the basis. So 18,000 minus 12,000, a $6,000 gain. And his basis in the shares or the total 18,000 because he just stepped up the basis by paying tax on that gain. So it's not a 351 transfer at all. It's just a taxable event. All right. So now the next one, number 4 is what we'll do next. This one is about the excess liabilities that we discussed in the lecture. So if you have excess liabilities, meaning liabilities higher than the basis that you're transferring in, then you know you have a taxable event up to the amount because you can't throw the two of them in there with a negative basis. So when you transfer an asset subject to a liability that's higher than it, you have to bump up the asset value to the amount of liability, and you're going in as if those two affect no net value for the corporation. And basically you pay tax on the increase as if you sold that asset to the corporation. So Diego has a recognized gain in this deal. He had basis of 260 and the fair market value was 350. Doesn't have to recognize all of the value of the asset. He just has to recognize up to the amount of liability that the corporation assumed for him. So here's what they said. He had basis of 260, fair market value was 350, and he gets 100% of the stock, so it is eligible for a 351 exchange, but the corporation assumes a liability for the real estate in the amount of 300,000. So he has to step the basis up to 300,000. That's what the basis in his stock is going to be. And he's going to pay tax or have a gain of, he's going to pay tax on the gain, which is the difference between 300,000 and 260. So he's going to have a gain of $40,000 and a basis in the new stock of 300,000. He's still got a $50,000 deferred gain that won't arise until he actually sells his stock shares then, because the assets he transferred in were actually worth 350,000, and he's only got a basis in them of 300. So that other $50,000 basis gain deferral is going to show up as a gain if he ever sells the stock. So he doesn't actually eliminate the gain. The 351 exchange, the benefit of it is a deferral of the gain until such time as the stock is sold. Now, number 5 is the next one. This one is about a gain that arises because boot was received. Boot is generally cash that's part of the transaction. So if an individual contributes to the corporation a certain amount of asset value, and then the corporation gives cash back to that individual, then that's considered boot. So up to the extent of boot, gain is recognized. So let's look at what happens here. Yvonne and Simon form Eon Corporation. Yvonne transfers equipment with a basis of 110,000 and fair market value of 165,000. Simon invests 130,000 of cash. They each receive 100 shares of Eon Corporation worth $130,000. But Yvonne also receives 35,000 in cash from Eon. So they're trying to balance her out where she winds up with the same invested amount as he, or invested share as he does, I guess. So they want us to calculate Eon's corporation's basis in the equipment and determine Eon and Simon's basis in the Eon stock. So Eon's corporation has basis in the equipment based on the fact that Yvonne gave them $110,000 worth of asset that was $110,000 basis to her, and she's going to have to pay tax on that boot that came in, that 35,000. So the part that their basis is the total of 110,000 plus the $35,000 boot that she received. So the basis in the equipment is 145,000. That's also the amount that Yvonne assume that Yvonne, it's the same effect as if Yvonne sold the equipment for 145,000. So she's going to wind up paying tax on 145,000 minus the 110. So that's a $35,000 gain. They didn't actually ask us how much her gain was, but it would have been 35,000. And so that gain that she had to pay tax on increased her basis in the stock. Increased the corporate's basis in the equipment, but it didn't increase her basis in the stock. Instead, she's getting the stock with the basis of the same as she gave the equipment for. So, and then Simon has basis of 130 because that's the cash that he gave. So the step up in basis to the corporation is because they actually have two things going. Yvonne gave them her $110,000 worth of assets, then carryover basis went with it. And then they gave her 35,000 for her, for the trade. And that was an additional 35 they invested in her equipment, basically. So 145 for the equipment basis. And then each of the individuals took the stock they invested in at their original trade amount. If they had not given her the cash back, it would still be the same. Then she would have had corporate would have had a basis of 110 still also. But they did. So we have to show it as a gain to her. She's taxed on it, but she's got the cash too. So it didn't affect her basis in this stock because she actually received the cash. Okay, so the next one, let's see, this one is 12.7. On this one, we have Crane and Loon corporations, two unrelated C corporations, and they have these transactions. They have gross income, expenses, and dividends received from other corporations. So they're asking us to compute the dividends received deduction for each of these two corporations. They're not related to one another, but they do have different results and they are treated differently. So there's 3 steps in doing the dividends received deduction. They have a good example about this in the book, but I'm just going to work through this one so you can see. Step 1 would be look at 1/2 of the dividends that they received. Since they both own this 15%, both these corporations own a 15% share of another corporation. That means that's going to be a 50% deductibility for dividends received, assuming it doesn't meet a limitation. So step 1 is see what the 50% is. So I'm looking at 50% of 100,000, be $50,000 is one of the options for Crane. And then 50% of the 230 would be 115 is what I might, those are like the outside limits on how much my deduction can be. $50,000 for Crane versus 115 for Loon. Okay, so that's how much my deduction might be unless one of these limitations hits me. All right, so for Crane, the second step is look at what the income would be if you included the gross income of 180 plus the $100,000 dividends that are coming in. That's 280 minus 255. So that would put you at 280 minus 255, $25,000 in net income if I included all the dividends and didn't have any dividends received deduction. So 25,000. And so the second limitation would be half of that 25,000. So I've got 2 options now. I might have a $50,000 deduction for Crane, or I might have a $12,500 deduction. And that's because that's half of the net income. When you take 180 plus 100 for the dividends minus the expenses of 255. So far it might be 50,000 or it might be 12.5. But there's this rule, the loss rule, and I mentioned it in the notes, in the lecture notes, but this one helps you flesh it out when you see this. And it says, when you look at the income with and deduction without, when you look at the income 180 minus 255 plus 100, so that was that 50,000, let's see, 280, $25,000. If you looked at that 25,000 and you were able to deduct the step 1 cost, dividends received deduction. So if you had a $25,000 net income and you deducted $50,000 of dividends received deduction, would that throw you into a loss? For Crane, yes, it would. You would be in an NOL position. If you took your dividends received deduction at the full 50,000, subtracting it from your taxable income, 180 plus 100 is 280 minus 255, puts you at a taxable income without dividends received deduction of 25,000. And so 25,000 minus the 50 full dividends received deduction would have been a loss. And so when that happens, they let you take the whole 50. So don't ask me why. I just know they do. So $50,000 is the amount. And they have some examples about this in the textbook. So maybe they have a better reason why, but than I don't know. They just do. But they might be explaining it in more detail to give you a reason why. But I'm just telling you, these are the steps you have to proceed through in order to come to the correct deduction for dividends received. And so in that one, we were able to take the whole otherwise allowable loss, 50% of the dividends, as a dividends received deduction. All right, so that's not the way it's going to happen with Loon, though. Watch what happens when you do the same procedure for Loon. For Loon, we had half of the dividends received with $115,000. So we're going to try to take the net income or the taxable income for Loon and subtract 115 from it to see if it throws us into a loss. Okay, so we have the gross income of 300,000 plus the dividends, so that's income. So it's 530,000 minus 310 for the expenses. 530 minus 310 put us at 220. Our taxable income is 220. And so if we took 220 and tried to deduct half of the dividends from it, it would be 220 minus 115. Would that throw us into a loss? No, it wouldn't. It would still be a net income. And so we can't do the loss rule that throws you back to, okay, you can take the full thing then, because it's not a net operating loss. And so this rule we have to go with is step 1 and step 2, take the smallest of the two. And so the step 1 result was half of this 130, which would have been 115,000 we could take. But the step 2 deduction is lower. It is 300,000 plus 230, which would be 530, minus 310, which is 220. So half of the taxable income is only $110,000. And that's what the answer is. So we can't take the whole 115 because we got limited by the taxable income. If taxable income is lower than the dividends that you received, it means you use taxable income. Unless the crazy exception like we had in Crane, unless that dividends received deduction was going to throw you into a net operating loss. And in Crane's case, it did throw you into a net operating loss. So you got to take the full $50,000, which was half of your dividends. And in Loon's case, the dividends received deduction did not take you into a net operating loss. So you were limited by half of taxable income, which was 220 times half, 110. So that was a little bit sticky, but it's just a matter of stepping through the rules. And so look back through the exercises in the textbook where they show how to do these also, and it's going to clear it up a lot. You got to do that with step 1, step 2, step 3. And when you step through it, you're going to come to the right conclusions. Your homework also has one like this, I think. So that's pretty much the examples we would do in class. Thanks.